Assalamualaikum everyone. This presentation proposes are to explain analysis of the different capital structures and dividend policies implemented by FarmFresh Berhad. My team already prepared a report and conduct every research from various information about FarmFresh. I am Maizat Fariza as a leader team for this group. In my group, we also have financial analysis, which is Nur Shafiq Amiza, researcher Amna Sabrina, Sofina Marsha, Hidayat Jana, and me. And for presenter part, all of us was involved into it. So now we go to the first part, which is Introduction to Capital Structure and Dividend Policy. So under capital structure, it reflects the mix of debt and equity used to fund a company's operations and asset, which is debt to capital and debt to equity ratios. Equity involves raising funds through shares that involve borrowing, for example, like loans and bonds. It gives impact cost of capital, financial risk, and flexibility. So under dividend policy, it determines how and when dividends are distributed to shareholders. It influenced by financial health, growth opportunities, capital needs, and shareholder preference, which is it have several types: cash dividends, when the shares stable, irregular, or no dividends. It reflects the company financial health and helps investors assess potential returns. And next, strategy decision on capital structure and dividend policies are essential to balance shareholder interest and ensure long-term company sustainability. So next we go to the concept of capital structure and dividend policy. So definition of capital structure is referred to a company's mix of funding sources, which is equity and debt. So for the equity, it will give example for common and preferred stock, and for the debt is bonds and loans. And next we go to the optimal capital structure, which is balances cost and benefits of debt and equity to reduce the cost of capital and enhance shareholder value. And for the debt, it will give tax advantage, for example, like interest deductible, but increases the financial risk. And for the equity, it reduces financial risk but is costlier and dilutes ownership. And for the impacts, it will affect financial stability and resilience to economic challenges. And business must maintain a balanced structure to ensure stability and achieve long-term goals. Thank you. So now we go to the advantage and disadvantage capital structures. So the first one is advantage debt financing. So tax benefits. It will give interest payments are tax deductible. Next we have leverage equity, boost return on equity if investment exceed the cost of debt. Next we have ownership retention. Existing shareholders maintain control. The last one is predictable cost, which is fixed loan installments aid in financial planning. And now we go to the disadvantage debt financing. The first one is eligibility hurdles, which is requires strong credit revenue, there's holes and operational history. Next we have high risk, which is risk of predatory lenders with high debt cost. And the last one is credit rating impact, which is loans can lower credit scores. So for the advantage equity financing, the first one is alternative to debt for startups and high-risk businesses, access to angel investors, venture capitalists, or crowdfunding. And the last one is involved investors may provide mentorship and growth support. And for the last one is disadvantage equity financing. It have ownership dilution, which is investor claim a portion of profit and control, no tax benefits, which is dividends are not tax deductible. And the last one is higher long-term cost, which is investors expect higher returns than lenders.
FarmFresh, a Malaysian dairy brand that has redefined the industry with its commitment to freshness, quality, and ethical practices. FarmFresh, founded in 2009 by Lloyd Twen Lee, FarmFresh operates on a unique grass-to-glass model, ensuring that every product maintains exceptional freshness and is free from artificial additive. FarmFresh's dedication to excellence has earned the title of Malaysia's leading dairy brand. Some of its key achievements include: first, becoming the first in Asia to receive the Certified Human certification for ethical animal treatment. Next, winning prestigious awards like the ACE Award 2021, Asian Inclusive Business Award 2020, and the Putra Brand Awards Platinum for 3 consecutive years. These accolades reflect FarmFresh's unwavering commitment to quality and sustainability. FarmFresh operates on an impressive scale, both locally and internationally. The company manages 5,000 acres of farmland across Malaysia and Australia, home to over 11,000 cows. Next, its product line includes over 200 items, ranging from fresh meat and beverages to ice creams and snacks. FarmFresh has also expanded its reach globally, exporting to Southeast Asia, Singapore, Brunei, and also Philippines, and the Middle East, leveraging its Australian processing plant. Their success stems from their philosophy of maintaining the highest quality while expanding responsibly. FarmFresh is not just a business, it's also a community-centric organization. Through its Cool Milk program, FarmFresh has provided nearly 65 million milk packed to 3,400 schools since 2011, contributing the health and nutrition of children. The company also empowers communities by supporting over 2,000 micro-entrepreneurs through its Home Dealers program. This initiative exemplifies FarmFresh in belief in doing good by doing well. Looking ahead, FarmFresh is committed in expanding its footprint across the Asia-Pacific region. The goal is to promote healthy, sustainable dairy products, ensuring that every consumer benefits from their philosophy of freshness, quality, and ethical practices. By continuing to innovate and serve communities, FarmFresh is poised to remain a leader in the dairy industry. In conclusion, FarmFresh is not just a dairy brand, it's a symbol of Malaysia's potential to lead in ethical, sustainable, and high-quality food production. From humble beginnings to becoming an industry leader, FarmFresh proved that with the right values and vision, we can achieve incredible things.
For the definition of dividend policy, a dividend policy is a strategy that determines how much of a company's profit are distributed to shareholders versus retained for growth. There are 6 types of dividend policies. First one is regular dividend policy, that consistent payouts, ideal for investors seeking stable income from reliable cash flows. And then stable dividend policy, which consists of predictable dividends with slight variation based on profits, balanced reliability and performance. And then irregular dividend policy, dividend based on financial performance that offers flexibility but can be unpredictable. And then residual dividend policy, that dividend paid after meeting capital and operational needs, variability based on remaining profits. And then constant dividend policy, that consists fixed percentage of earnings as dividends. Variable payouts may fluctuate with earnings. And the last one is hybrid dividend policy that combines strategies that offers a stable base dividend with additional payouts during strong profit periods. This is the advantages and disadvantages of dividend policy. For the advantages of dividend policy, it will attract investor because consistent dividends draw income-seeking investor that enhancing company stability perception, and then it will indicate profitability because regular payout signal financial health, boosting market reputation and potential increasing stock value. And then the tax benefits, dividends are often taxed at lower rates than other income types, appealing to investors wanting to minimize tax liabilities. And then it can boost shareholders' confidence because regular dividends foster loyalty and positive market perceptions. For the disadvantages of dividend policy, it will reduce flexibility because changing a dividend policy can be challenging, risking investor dissatisfaction if cuts are necessary during financial downturns. And then it will decrease reinvestment because high dividends limit retained earnings available for growth opportunities and potentially hindering expansion and innovation. And then investor may develop expectation for consistent payments, and failing to meet these can lead to stock price declines. And the last one, potential signals of weakness. Its paying dividends may suggest a lack of profitability reinvestment opportunities and impacting market perception negatively.
Now onto the research question. For number one is how do companies make decisions regarding their capital structure and dividend policy? From Fresh Berhad, as outlined in the financial highlights and the governance approach, adopted a strategic approach to capital structure and dividend policy decisions to ensure sustainable growth and shareholder value. As for the capital structure decisions, Farmfresh had effectively managed its capital structure in 2023 to support growth while ensuring financial stability. It utilized debt financing, securing an 4.5 million loan for new farm property and equipment in K-Bram, Australia. The company also expanded trade financing and revolving credit facilities for short-term liquidity needs. Despite an increase in its debt-to-equity ratio from 0.48 to 0.55, Farmfresh maintained resilience, demonstrating a strategic balance between debt and equity for ongoing growth opportunities. As for the dividend policy decisions, Farmfresh Berhad emphasized rewarding shareholders through a sustainable dividend policy, targeting a 25% distribution of annual net profit. For financial year 2023, it exceeded this goal with a final dividend of 1 cent per share, totaling RM 18 ringgit per 0.7 million and a 37 payout ratio. This reflects the company's commitment to shareholder value amid challenges while ensuring sufficient capital for investment and sustained growth. As for the second one, what current practices Farmfresh employing to optimize their financial performance? In 2023, Farmfresh Berhad implemented various strategic practices to optimize its financial performance amidst the challenging microeconomic conditions. These practices focus on expanding revenue streams, managing costs effectively, and enhancing operational efficiency to ensure sustainable growth. For the revenue diversification and growth, Farmfresh Berhad aimed to diversify its revenue sources by entering new market and expanding its product range. They introduced Farmfresh Go, a milk product for children, and Yara by Farmfresh UHD items, targeting underserved markets. They also purchased Insights Group, an ice cream brand, to enter the growing Malaysian market. Geographical growth was also a priority, acquiring farms and facilities in Australia and building a new facility in the Philippines to meet local dairy demand. These efforts utilize the company's assets and create a new revenue opportunities. For the cost management and operational efficiency, Farmfresh Berhad implemented cost management strategies to protect profitability amidst rising input costs. They increased trade financing and revolving credit facilities, refined production methods, and invested in technological advancements and equipment upgrades. They grass-to-glass approach improved supply chain oversight, lowering third-party expenses, and boosting cost efficiency. The company also invested in technological advancements to meet increasing consumer demand. For sustainability and renewable energy initiatives, Farmfresh Berhad has enhanced its financial performance and corporate responsibility by utilizing renewable energy, such as a biogas facility at Muazzam Shah Farm, and expanding its solar energy initiative with rooftop system at multiple locations. These initiatives aim to reduce dependence on fossil fuels and carbon emissions, ultimately reducing operational expenses. And for the last one, strategic acquisitions and investment. Their financial performance was improved through acquisitions, including St. David Dairy, a Melbourne-based dairy company, and investment in expanding its Insights Group outlet network and CPG ice cream range. The company also invested in infrastructure, including a manufacturing hub in Bandar and Stag, scheduled for completion in 2024, to enhance its manufacturing processing and capabilities and meet growing product demand.
Question 2 asks for the factors influencing capital structure and recent economic conditions. The factors involve business risk. Farmfresh Berhad's capital structure is influenced by business risk, including demand fluctuations and regulatory changes. Its strong market position allows for moderate debt levels without significantly increasing financial risk. And then the factor is financial flexibility. The company emphasized financial flexibility to invest in new facilities and production improvements, enabling quick response to market demands and expansion opportunities. And then the cost of capital. Low interest rates make debt financing attractive, facilitating growth initiatives. In 2023, a net gearing ratio of 0.54 times reflect a balanced financial strategy. And for the recent economic conditions, post-COVID-19, recovery has led to increased consumer demand for dairy products. FarmFresh revenue rose from 629.7 million ringgit in 2023 to 810.4 million ringgit in 2024, positioning the company for informed investment and financing decisions. These factors collectively guide FarmFresh Berhad in navigating the competitive dairy sectors while adapting to current economic conditions. Examples from other companies adjusted their capital structure to change market conditions. First is AirAsia, also faced significant challenges during the COVID-19 pandemic, securing capital through equity offerings and loans to enhance liquidity. This strategy helped sustain operations and position the company for recovery as travel demand rebounded. And then, next company is Nestle Malaysia, that focused on managing debt levels effectively while pursuing growth. The company balanced its capital structure to maintain financial stability amid changing consumer trends. This example illustrates how companies adapt their capital structures in response to market pressures, optimizing debt for sustainable growth or increasing liquidity during crises.
For question 3, which focuses on the factors influencing companies' dividend policies and how they decide on these policies. Dividend policies are crucial for balancing a company's financial health and meeting shareholder expectations. First, we have profitability and cash flow. For a company to consistently pay dividends, its profit must be sustainable, backed by strong cash flow. Without this foundation, dividends become unreliable, which can affect shareholder trust. Next is growth opportunities. Companies in high growth sectors often reinvest profits to fuel expansion rather than distribute them as dividends. On the other hand, more established firms with fewer growth prospects may focus on offering higher dividends to shareholders. Debt levels are also a critical factor. Firms with high debt often prioritize financial stability over payouts. This ensures they meet debt obligation first, maintaining a solid credit rating and long-term financial health. Another key factor is industry trends and expectation. Companies often align their dividend policies with competitors to stay attractive to investors. Additionally, understanding and balancing the diverse needs of investors is crucial for long-term success. Lastly, regulations and economy play a significant role. Legal requirements and economic conditions heavily influence when and how dividends are distributed. For example, during economic downturns, companies might retain earnings instead of paying dividends to safeguard their operations. Next, key factors that influence dividend payouts. Companies carefully consider this aspect to strike a balance between rewarding shareholders and maintaining financial stability. First, earnings stability and profitability. Steady earnings are crucial for consistent dividend payouts. If a company's profits are volatile, it becomes challenging to maintain reliable dividends, which can impact investor confidence. Next, we have cash flow. Adequate liquidity ensures that a company can pay dividends without disrupting its daily operations. Strong cash flow management is essential to meet both operational and shareholder needs. Growth opportunities also play a critical role. Companies in high growth sectors often reinvest their profits to fund expansion and innovation, which might lead to lower or no dividends. In contrast, established firms with limited growth prospect tend to prioritize higher dividends. Debt levels are another key factor. For companies with high leverage often reduce their dividends payout to strengthen their financial health and meet that obligation. Maintaining a healthy balance between dividends and debt management is crucial for long-term sustainability. Next, shareholder expectations. Investors often have different priorities. Some focus on income generation while others prefer reinvestment for growth. Companies must balance these needs when designing their dividend policies. Lastly, market conditions. Economic downturns or financial uncertainties may lead companies to lower or suspend dividend payout to preserve cash. Flexibility in responding to market conditions is essential for a company's resilience. Next is example from others companies of change in dividend policies. For Intel Corporation, in 2023, they reduced quarterly dividend by 66% due to falling revenues and semiconductor demand. They also shifted investment toward factories and new products to recover financially. Next, for Disney Corporation, they resumed dividends in 2023 post-COVID-19 suspension. They balanced small payouts with heavy reinvestment in parks, streaming, and content production. Next, for ExxonMobil, they increased quarterly dividend by 4% in 2023, leveraging record oil and gas earnings. They demonstrate financial stability and align with industry benchmark. Lastly, for Meta Platforms, they announced first ever dividend payout in 2023, signaling a shift from growth to stable revenue streams. They aim to attract income-focused investors while reinvesting in strategic initiatives.
So for the question 4, which is balancing growth, investment, and shareholder dividends. So the first one is balancing growth, investment, and dividends. So under capital structure, it maintains prudent debt to equity ratio. Current ratio is 0.54, which is target less than 0.8, and utilize low cost debt for high yield projects while minimizing financial risk, and avoid excessive borrowing, use debt for large one-time outflows, for example, like facility upgrades. And for the growth strategy, we have to reinvest profit in expanding manufacturing capabilities, developing new products, gaining market share, and we need to seek acquisition to enhance competitive advantage. Other than that, under dividend policy, adopt constant dividend payouts, which is 30 until 40% of net profits. We have to pay exceptional dividends during singular high profit years, and we need to link dividend increases to profit growth. So under transparency with investor, we need to communicate honestly about dividend policies and capital allocation, mixed funding strategy, use retained earnings and external sources, debt or equity for balanced growth. And the last one is focus on efficient capital use for short-term and long-term goals. So now we go to the examples of companies successfully balancing growth and dividend. So under capital structure, it's maintained a prudent debt to equity ratio of 0.54 for stability and expansion. And invested RM 105 million in property, plant, and equipment final year 2024 to boost production and efficiency. Finance acquisition, for example, like the Inside Scoop Senior Berhad and Seymour Ice Cream Senior Berhad, with retained earnings and low cost debt to diversify products and generate new revenue streams. So now, under dividend policy, which is declare 1.20 cents per share dividend, RM 22.5 million, aligning with a 30 until 40% net profit payout policy, and it will ensure stable shareholders' return while retaining profit for reinvestment. And last one is special dividends during exceptional profit years, encourage consistent rewards. On the contrary, Farm Fresh Berhad has created a model where strategic investment and financial prudence complement each other in such a way that the company can grow its business operation while continuing to reward shareholders with sustainable dividends. By marrying targeted growth investment with careful financial management, Farm Fresh sets a benchmark for balancing long-term business expansion and short-term shareholders' returns.
Assalamualaikum, my name is Misha Kamiza. Today I will present an analysis of our fresh capital structure, focusing on their financial management and leverage strategy as of 31 March 2023. First, look at the company asset and equity. Farmfresh record total asset of 1062.6 million ringgit, with shareholder equity at 635.9 million ringgit. This translates into the total liability of 4 to 6.7 million ringgit. Next, the debt to equity ratio, which is the formula is the total liability divided by the shareholder equity, which stands at approximately 0.67, reflect at moderate level of leverage. This ratio is in line with undrastic growth strategy, balancing risks and probability of expansion. Importantly, a ratio below 1.0 is often seen as a hallmark of strong financial management. It minimizes risk while still providing room for investment and growth. Farmfresh leverage strategy is evidence in their effort to stabilize their capital structure through target investment and efficient cost management. Although the company does not disclose its weighted average cost of capital or WCC, we can reasonably infer that their moderate leverage likely help maintain a low WCC, ensuring stable financing costs. In the summary, Farmfresh capital structure demonstrates a well throughout balance between debt and equity, supporting both financial stability and growth opportunity. Next, I will discuss Farmfresh dividend policy for the financial year ended 31 March 2023 and its application for the company financial strategy. Dividend declaration. The board of directors announced a single share final dividend of 1 cent per ordinary share amounting to 18.7 million. This is subject to shareholder approval. Payout ratio, the company has paid out approximately one-third of its profit after tax as dividend. For example, if our fresh net income was 50.5 million ringgit, the payout ratio would be about 3.38%. This indicates a balanced approach, providing short-term return to equity holder while retain fund for reinvestment. The dividend yield is calculated based on the market price of the share. Assuming the share price is 150 cents, the dividend yield will be approximately 0.67%. The relative low yield reflects from fresh growth-oriented strategy. The company prioritizes retained earnings to reinvest in expansion, market share improvement, and innovation. These retained earnings are critical for funding capital expenditure and maintaining competitiveness in a dynamic market environment. Finally, the dividend policy aligned with the industry practice, balancing shareholder return while ensuring sustainable growth. Farmfresh approach demonstrates a commitment to its long-term objective and investor satisfaction.
As for the recommendation for the optimal capital structure and dividend policy for Farmfresh Berhad, their financial strategy in 2023 reflects a conservative approach to capital management with a gearing ratio of 0.55 times. This level demonstrates a balance of use of debt and equity to support the company's growth and operational stability. For the optimal capital structure recommendation, firstly, increase strategic leverage for growth projects. They should increase leverage for high growth investment, maintaining industry standards and the debt to equity ratio below 0.7 times to balance risk and growth potential. For the second one, strengthen equity base through strategic issuance. They may consider issuing equity for large-scale projects with long-term payoffs, like infrastructure expansions or international market entries, to reduce debt financing and align shareholder interest with growth strategy. The third one, optimize working capital management. They can improve trade financing efficiency, reduce interest costs, and enhance inventory management to maintain a strong working capital position. And for the last one, diversify financing sources, introducing innovative financing instruments such as green bonds or sukuk aligned with sustainability objectives can attract investors with ESG priorities and potentially reduce the cost of capital. We proceed to the optimal dividend policy recommendations. Farmfresh's current dividend payout ratio stands at 37%, indicating its commitment to returning value to shareholders while keeping funds for investment. Firstly, maintain a progressive dividend policy. They should aim for a sustainable dividend payout ratio of 30% to 40%, ensuring stability for shareholders and operational investment and adjusting based on annual profit performance. Second, introduce the dividend reinvestment plan (DRIP), reinvesting dividends into
Their share can save cash and boost shareholder loyalty, particularly during high capital expenditure periods. The third one, link dividends to cash flow stability. Aligning dividend declarations with operating cash flow rather than net profit ensures sustainable payouts, enhance resilience amid economic fluctuations, and support steady shareholder returns. And lastly, enhance shareholder engagement. Transparent communication about dividend policies, payout decisions, and future expectation is crucial. And investor briefings and the company's investor relation policy help build trust.
In the conclusion, Farmfresh Berhad is a shining example of a comprehensive approach to financial management with a focus on shareholder value and sustainable growth. The company prudent use or leverage to accomplish its development goals while maintaining financial stability is demonstrated by its respectable debt to equity ratio of 0.55 in 2023. Farmfresh forward thinking strategy is demonstrated by its intent to diversify its revenue resource, improve cost control, and farm sustainability project. The business guarantee operational effectiveness and a less environmental impact by using renewable energy solution and by emphasizing vertical integration.